Hello, hello, hello. My name is Patrick Brenner. I am your host of SPPI-TV and the president of the Southwest Public Policy Institute. Today, I am pleased to be joined by Ed Harris, not the actor. Ed Harris is the founder of Harris Northwest Advisors, and we met in the aftermath of SPPI's national debut, the Wall Street Journal article, the case against 30-year mortgages, and shortly after the publication of that piece, President Donald Trump proposed 50-year mortgages as the future for American housing finance. And we're here today to discuss all of what that entails. Ed Harris, thank you so much for joining me today. Welcome to SPPI TV. I think this is episode 2029. So I'm pleased to be joined by the famous Ed Harris. Yes. Tell us a story about how you were confused with the actor. I want to get that on the record.
Sure. Well, first of all, Patrick, thank you for having me on as a guest. I appreciate it. I know this wasn't the intended topic of conversation, but since you asked, so just real quick story. Earlier in my career, currently I run an investment banking firm. We work with privately held companies that are looking to get acquired. We also work with startups that are trying to connect with investors. But earlier in my career, I had done some work in the venture capital, early stage company space here in Seattle, which is, as I'm sure you're aware, a significant market for those types of companies. And there was one company that I was involved with where our firm had invested in that had a take on Hollywood with a new technology kind of strategy. And as a result of that, we had a board member who was the CEO of one of the top talent agencies in Hollywood. I think they were either number one or number two. And anyway, that particular company ended up not being terribly successful. Although actually the founder of that company went on to found a company called Roku. So he definitely made it big, just not on that one. I kind of just forgot about it. It was just another deal. Life went on. And then my daughter, who was probably about 14-ish, 13, 14, 15, maybe 15 years old at the time, became one of the many millions of Harry Potter fans. That I forget which movie it was. I think it was the fourth one in the franchise was premiering, and that premiere was going to be in New York. And my daughter said, gee, Dad, why don't you see if you can get us tickets to that? And I said, well, I don't think you realize the magnitude of what you've asked. That's for celebrities and industry insiders, and I'm neither of those things. And then about a week later, there was an article in the Wall Street Journal, and they mentioned that back then the print newspaper was a bigger deal, and headline of the above the fold headline was about that particular agency and the individual that I had worked with as a colleague at this startup a few years earlier, which I, to be honest with you, I entirely forgotten about, and I thought, oh, let me give him a call. Maybe he'll it's like a desperate request, but who knows, maybe I'll get lucky. So I give him a call and I say, hey, it's Ed, remember we were sat on the board together of, company XYZ. And my daughter is the biggest Harry Potter fan in the world. And, boy, it sure would be cool if we could get some tickets for the premiere in New York. And he said, sure, no problem. Hang on the line, and my assistant will pick up the call. So I assumed, well, that's the world's fastest brush off. And the assistant picks up. So she asked for the details, email, whatever, and I ended up getting 4 tickets. Then what I realized is he probably just called across the office, hey, I've got Ed Harris on the line. And she probably figured, well, he's the biggest talent. This is a talent agency. If you've got Ed Harris on the line with Ed Harris. So anyway, we fly to New York. I take my daughter's best friend, and my second son, and we go to the premiere. And there's like a red carpet outside the theater, and there's a tent, and there's like these boxes with tickets in them, and everything's like a jumbled mess. And so I walk up, and there's a guy. There's like 3 or 4 people, and the guy's kind of looking down, and he's like riffling through envelopes, trying to hand people their tickets. And I say, "Hi, I'm Ed Harris." And he looks up, and he says, "No, you're not." And I said, "No," I said, "my name, and there's tickets with my name in this box." And it's the most disorganized, chaotic mess you've ever seen in your life. It's just like hundreds of envelopes literally in a box, as low tech as you could possibly imagine. And the guy says, "Oh, they're really not assigned seats. Just go ahead." He waves me and the kids in. Turns out they are assigned seats. So somebody comes along, right, like a minute or 2 before the movie's going to start, and says, "Hey, you're sitting in my seat." And I panic because I have this sudden vision. Oh my God, it was the biggest deal of my daughter's life, and now we're going to get thrown out of the theater. I run outside as fast as I can, and there's like only 2 or 3 envelopes left, and there's my envelope with my tickets. The sort of the cherry on top is my daughter had an enormous crush on the actor who played Ron Weasley, Rupert Grint, and we ended up sitting literally like behind him. It was like, here's Rupert, here's my daughter, so I was a hero to my kids, which as a parent, that's hard to pull off. And it was all because, somebody, a big shot in Hollywood, just assumed, well, Ed Harris, who else would it be?
That's awesome. You got to be a hero out of it.
I was a hero for a day. Yeah.
Mission success. Nicely done, Dad. All right. So let's talk business. Business. So we wrote a column for the Wall Street Journal called "The Case Against 30-Year Mortgages." Just everybody needs to be aware, I do not come up with the titles. That was not my call. I had zero input. I wish it would have been different. It was not designed originally, the column itself, as a critique of the entire concept of 30-year mortgages. It was really truly designed to inject into a national conversation an argument against APR, or annual percentage rate, which it is of the opinion of the Southwest Public Policy Institute that APR is one of the most disingenuous universal cost metrics by the mind of man. And that is our opinion. We would like to see the Truth in Lending Act reformed to prohibit the usage of APR in financial product advertising. I know that's an extreme position, but that was the intent of the piece, was to really inject that argument into a national conversation. And then it morphed over several iterations of editing into this primer against mortgages. And I'm like, oh God, I'm going to piss off every mortgage banker across the entire country. And lo and behold, the Mortgage Bankers Association picked up on that. And, you and I, Ed, had a really good dialogue after the fact about how 30-year mortgages and long-term financial products like that actually are incredible wealth building mechanisms for ordinary American families. And let's talk about your position as a wealth advisor on 30-year mortgages and long-term financial products like that. Just give me your pitch.
Sure. So first of all, just quick correction. I'm not a wealth advisor, which is a different category of financial professional that I'm not. So I work with companies, specifically with companies. I never give advice to individuals. And if I do, they should probably take the opposite, choose the exact opposite of what I'm recommending, because I don't have a great track record. But I do think I know my stuff. When it comes to corporate finance, I think I know my stuff.
Sure,
So first of all, I think I'll say that I politely disagree with you, but let me tell you why. At the start of my career, so I've been doing this for a long time, and at the start of my career, I did a lot of work with airlines and aircraft. If they're operated by responsible carriers and properly maintained, they have pretty long useful lives. I mean, generally, planes can fly, up to 25 years or so. There was a crash, actually, a FedEx crash in Memphis not too long ago, which was very tragic, and a number of people died. That plane was 34 years old. Maybe 34 years old is a little bit too long to keep on flying, but planes can operate pretty safely, for 20 to 25 years. And so aircraft leases generally align with the expected life of the airplane. So if airlines typically finance their planes with leases. Those leases are usually about 18 to 20 years in length, with the thought being that, well, you got about a 20-year window of economically useful life out of a plane. So 20-year financing, the economic life of the asset aligns with the term of the term and length of the debt. So I think that's a pretty basic. I would say it's a non-controversial opinion on Wall Street. I don't think anybody on Wall Street would say there's something flawed in that logic. So I think that's the principle that I start from is, what's the asset that you're financing? So for example, if you're buying a car, you're not going to get a 30-year loan on a car, because that would be crazy, because a car is not going to last for 30 years. And so that creates the moral hazard that at some point, the borrower is going to say, hey, I owe $20,000 on this car loan, but the car's only worth $5,000. Hey, here's the keys. You can have it back. So I wanted to sort of just frame it within that context. And so within that context of the life of a house, now a house is not an economic asset in the same way that an airplane is operated by United or American or Delta. So it's not a perfect analogy. But houses last a pretty darn long time when they're well maintained. And generally speaking, people buy houses, their first house at least, when they expect to have a lot of years of earnings ahead of them. So I don't, to be honest with you, I don't really see what's dangerous or maybe deceptively marketed. There's a lot of deceptive marketing around interest rates and the cost of money when it comes to consumers. If miss a credit card payment and your APR is 30 or 40%. There's a lot of these buy now, pay later or pay over term companies that claim it's zero interest until you're like, one day late on your payment, and all of a sudden your interest rate's 30 or 40%. So there's a lot of deception and bad actors out there. I don't think the 30-year mortgage is one of those. I think it's a pretty vanilla, form of financing designed particularly for the first-time buyer who's thinking they've got 30 years of earnings power in front of them. I don't think it's really. I think it's kind of boring.
Sure.
Bland. I don't think there's any sleight of hand going on in there.
Okay, fair enough. It's not to say that I'm not a believer in the 30-year mortgage concept or the product itself. I have purchased now 2 homes using 30-year mortgages each time, and I'm a buyer of the product. I've used it. I've leveraged it myself. I'm planning on staying in this house for as long as I can to maximize the equity that my family and I build in this home. Again, it was not meant to be a primer against the 30-year mortgage concept. It was more designed as a primer against why subsidized credit actually inflates the cost of housing, why it's created an affordability crisis. I'm a millennial, Ed. I was born in 1991, and I cannot tell you how many times I have heard other members of my generation complain about the cost of housing, the cost of school, and it gets really old, which is why I started that article.
True.
I usually roll my eyes at the chorus of millennial complaints. That was how it was originally started. They took out the chorus of millennial complaints. They just called it that.
Yeah, and it's true. It's actually, you're not wrong. It is true. Housing on a real dollar basis is way more expensive than it used to be. There's some other
ratio.
culprits.
Let's talk about the ratio of housing to household finance. Back in the 1970s, we do an analysis of gone are the 1970s when an average home could be secured for about $26,000 against an annual household income of just shy of $10,000, a ratio of 2.5 to 1. Today, the latest data shows that the annual household income is $83,000 and the average home costs 410, which is a ratio of about 5 to 1. So home prices have exceeded wage growth since the 1970s. So, I mean, there is certainly an affordability crisis, and I think that that was not caused by the 30-year mortgage, but government meddling in the marketplace with respect to subsidizing credit.
Yeah, no, I think you're 1,000% right on that point specifically. In real terms, housing is way more expensive, and it's also a kind of phony wealth. Like I have a lot of homeowner equity, so I live in a I'll call it a pleasant suburb of Greater Seattle, and my home's pretty modest as far as I'm concerned. It's 3 bedrooms, and this summer there was an open house. One of our neighbors had an open house. So what do you do on a slow summer day when your neighbor has an open house? You wander over and look at the house and see what the asking price is. And I bumped into another neighbor of mine, and he said, "Yeah, boy, I sure couldn't afford I couldn't afford to buy this house today." So in a way, it's not only is it has it inflated housing prices, but it's created a kind of almost an ersatz wealth, because the reality is, if I look, my mortgage company, the mortgage company, they're constantly peppering me with emails. Hey, you got so much equity in your house, you should borrow against it. But the reality is, I don't really have any equity in my house, because if I sold my house and tried to buy the same house, I'd be, I'd be impoverishing myself. I'd be worse off, afterwards. So
Sure.
I agree with you that housing is way too expensive, and governments probably contributed to that, very, very significantly. So yeah, for sure.
And we see the same problem with respect to, I know we didn't talk about this beforehand, and it's something that we're working on. You've got government subsidizing loans, and in that respect, the cost of tuition has skyrocketed over recent years, and that has certainly not kept pace with postgraduate. I'm sorry, like post graduation with bachelor degree earnings. Um, that tuition has skyrocketed, and we feel as though it's in part caused by in part, the most important part is caused by government meddling in the marketplace, government subsidizing credit, government making loans look cheap, and universities are insulated from that pricing pressure because students can always borrow more. And it's caused a problem with higher education affordability too. So our premise, the underlying argument in all of these cases that we're making, it's not the case against the 30-year mortgage. It's the case against government meddling in the marketplace, trying to subsidize different credit options and make the underlying product look cheaper, which has the opposite effect. Making credit cheaper actually makes the underlying product more expensive, but it makes the
Oh
credit.
yeah, for sure, for sure. I mean, in the case of higher education, that's very straightforward. Absolutely. A lot of people, unfortunately, it's funny. I publish a blog if anybody wants to go take a look at it. And I wrote a piece on this relatively recently, within the last couple of months. And there's a nonprofit out there somewhere, I forget the name of it, and they track the value of degrees from like a couple of hundred universities. So it's institution specific, and it's degree specific. So I remember, I may be wrong on, I'm going to quote you some examples, and I may be wrong on the exact numbers, but I'm directionally correct. So if you go someplace like UCLA and you study engineering, the net present value of your degree, meaning what you will earn over a lifetime versus what you paid for it is like $2 or $3 million. And if you go to UCLA and you study French history, the net present value of your degree is like negative $200,000. Like you will never, the cost, and it's not how much money you make, it's how much money you make above the median. Like how much did your degree pay off in terms of additional earnings power? And so even within the same institution, you have people that go to great schools, and if you pick the wrong major, when I say wrong, if you pick a major that isn't valued in the market, even if you go to a great school like UCLA, you can still end up upside down. So that one I think everybody's starting to come to terms with that. Everybody's starting to realize that, more or less all at the same time. So yeah, higher education is broken for sure. There's no question about that.
Sure.
It's financially broken.
I'm glad that we agree. And part of the problem is there's no requirement that the future income of the graduate justify the costs, and there's no consequence when it doesn't. So like once the student graduate or doesn't graduate, the bills are due all the same.
Yeah, I disagree on that because for so many years, I'll call it the government education complex. Eisenhower talked about the military industrial complex. So now we have the government, or we had until relatively recently, we had the government education complex. And so higher education has been very, very strenuously promoting a college degree pays off. And lots of government studies also promote that thesis, that I think the Census Bureau says if you go to college, you'll have an expected $1 million. I think it's $1 million more of lifetime earnings, a college graduate versus a non-college. It might even be a bigger number than that. I forget exactly. The problem is you're not measuring equivalent populations because in a lot of cases, the people who can afford to go to college come from families that are already doing well financially. And so that also provides that the coming from an upper income demographic boosts your earnings potential in lots and lots and lots of different ways. Not merely that degree. That's a separate topic. I know that's not what we want to talk about, but yeah, I think in education, it's spot on. In housing, I think it's a little bit more there's more moving parts in housing. It's a little bit more complicated. One of the things I think that is a challenge with housing is nobody really knows how expensive it is to own a home until you buy one.
Right.
And so it's like, and I live in I'll give myself as an example. I live in a relatively, I'll call it newish home. I think it was built, I'm not the original owner, but it was built about 20 years ago and built to a pretty high construction standard. It's a well-made house. But even in a well-made house, that's still, as far as houses go, pretty modern. I've probably put in, I don't know how many thousands of dollars since I moved here. And a lot of it is on just regular mundane stuff that is just like, it's expensive. You need a new dishwasher. It's expensive. You need a new microwave that's built into the cabinet. It's expensive. You need a new furnace. It's expensive. You need, service visits all the time. So I think that perception that, houses make people rich, well, they have historically gone up in value a lot over the last 30, 40 years, but
the average appreciation is about 3%, right? Year over year, I think, over the last several decades.
Say that again, I'm sorry?
The average appreciation on for homes in the United States over the last several decades is about 3% annually, right?
I don't know.
Right.
I don't know that statistic specifically. I'm not sure on that.
I suspect like historically they appreciate in value.
Yeah. Historically, yes. Historically, they appreciate in value for sure. So
let's not talk about 2008.
Yeah. I was going to make one other point, which is this is more of what happens when people are, regardless of where they are politically, what happens when people are established and successful. You don't want houses. You don't want a new house. You don't want more houses being built next to you. You don't want more cars on the freeway. More traffic locally. So there's this unfortunate impact that you see this in immigration too, which I know is not the topic of our conversation, but you might be just 2 generations removed from immigrant grandparents, but you're anti-immigrant yourself. In some cases, you might even be the immigrant, but you're anti-immigrant yourself. And it's kind of the same thing with housing, regardless of where you fall on the political spectrum. Most people don't want to see construction to be easy in their neighborhood, in their immediate neighborhood. So it's now just so much harder. It takes so much longer, the zoning approval, the planning approval, the soft costs that go to building a house. So you're mentioning, like the houses from the prior generations. In those days, they just started plowing, they just started, hey, here's where we're putting the 200 homes, and they just started building after a permit. And here it takes 5 or 10 years just to even, generally speaking, if you live in a place like Seattle, which is well-to-do and, very heavily managed from an administrative regulatory standpoint, you're not building a house in a year. You're building a house in 10 years.
Wow.
But I think that's pretty standard. That's standard in a lot of places.
Sure. I want to touch on that in a minute. Ladies and gentlemen, you're listening to episode 29 of SPPI-TV, the public policy podcast of the Southwest Public Policy Institute. I'm joined today by our special guest, Ed Harris, founder of Harris Northwest Advisors. Ed, where can people find out more about Harris Northwest Advisors?
Well, my website is harrisnwa.com, same as my last name. And my contact information is on the website. And just to sort of reiterate what I do and what I don't do is I don't work with individuals. I'm not a broker or an investment advisor. I work with companies, with businesses that are generally that are looking to get acquired and help them navigate that process.
Excellent. harrisnwa.com is Ed Harris's website for Harris Northwest Advisors. And we were talking about NIMBYism, essentially.
Yes, thank you.
With respect, yeah. Not in my backyard.
Exactly.
Quite literally
Exactly.
here. Yes.
Yeah, exactly.
We, in the aftermath of Trump's announcement for the 50-year mortgage concept, where he's got this picture of himself on with a 50-year mortgage, and he's comparing himself with FDR, which I really don't think was a good comparison, given who he is and how far right his movement is. Why are you comparing yourself with FDR? But you've got he's gone Truth Social media. He's got President Trump on the right or left with the 50-year mortgage, and then FDR with the 30-year mortgage. And we wrote a piece a couple of weeks ago for Fox News criticizing the 50-year mortgage concept because it was politically salient for us to do so. And in that piece, we propose a solution, which is make it easier to build new homes. The easiest way to make homes more affordable is to introduce more supply. I mean, that's just the classic economic argument. And in that piece that we wrote for Fox News, I quoted a specific local home builder, local to me. I'm in the Albuquerque area. I know Ed, that you're in the Pacific Northwest in Seattle. But our local builder, Mackenzie Bishop, he's with Abrazos Homes in Albuquerque. He laid it out. Local taxes and fees add more than $40,000 to the cost of every new home before a single nail is even hammered. That, and you're adding property tax increases of 50 to 70% on multifamily projects, and you get new construction grinding to a halt. And that's not even counting all the red tape for permitting and everything else that goes into a new home. I mean, you've got a real supply side problem. Building is screeched to a halt. New construction is a problem, and that's not even considering the corporate acquisition of single family homes that I know that many in this country are worried about right now. But what do you think, like, with respect to introducing new supply and the effect that it could have on existing home prices if we cut red tape and sort of inject a ton of new home construction into the marketplace? I mean, construction defects aside, associated with rapid construction like that, I mean, is that a reasonable solution to the affordability crisis?
Yeah, so I guess I would say two things about that. Absolutely, yes. I mean, it's classic Econ 101 for sure. And when demand exceeds supply, one of two things happens: either prices go up or supply goes up to meet that demand. Unfortunately, while it's true, it's also too simplistic of an argument, because housing doesn't get built by Washington, by Washington, D.C., housing gets built at the local level. And at the local level, I think pretty much every single community where people want to live because there's good jobs and a good opportunity to advance economically, every single place in America that fits that description, except maybe some parts of Texas. But for the most part, it's pretty darn hard, just like you were saying about your local home builder. There's a level of regulation that creates friction and slows down the process. And nobody has an answer to how to fix that. I don't want to say anything either positive or negative about Trump. He said, other than to say he says a lot of stuff, and one is never sure whether every single Truth Social tweet is a policy announcement or not, or I guess Truth Social post, I should say more accurately.
Sure.
I don't think the 50-year mortgage is a bad idea. It's never going to happen. It's not there. Nobody wants it. Financial institutions would not like the risk of a 50-year mortgage.
There is so much risk for
Yeah.
mainstream finance institutions in putting all that stock in such a long-term product.
Exactly. So it's not going to happen. I don't think it's a necessarily a bad idea. It's not like, oh my God, that's crazy. Realistically speaking, once you enter into a 30-year mortgage, 30 years feels so far into the future that making it longer feels about the same. It's like the number of stars in the universe. I don't know how many there are, and neither does anybody else, but it's a really big number. So I don't think it's necessarily that it's off point. I mean, it's off point in the sense that it doesn't address what you were just talking about, which is more supply. But more supply is going to require a tremendous rethinking of this issue in a lot of different places at the local level for there to be change. And I don't really see that happening. And one of the reasons why I feel this way is because it's not just an American problem. Housing is too expensive, or the trend that you described about it takes a greater percentage of income to buy a house than it did a generation ago, and that the supply of new construction has not kept pace with demand. That's true pretty much everywhere in the West, across Western economies. That's not a unique to America problem.
Sure.
So anyway, I think that's the part that nobody really has an answer for, other than to say, well, we should build more homes. But then it's like, well, okay, but how are we going to convince, for example, where I live, Issaquah, Washington, to say, hey, give out more construction permits, make it easier to build here? It's not going to happen.
Right. You're going to get a lot of pushback at the state and local level.
Yeah,
absolutely. I mean, the only reason I think that Trump gained any traction with that is Bill Pulte, Trump's housing chief with Fannie Mae, Freddie Mac, jumped on top of that right away and supported the 50-year mortgage concept, which is why that blew up all over social media. And we hopped on that just because it was a good political talking point for us, and we got to make the argument, well, build more, cut red tape, which is the typical free market, little L libertarian approach to everything, less government regulation, cut red tape, the whole 9 yards. Yeah.
But again, there's, Washington doesn't really have much influence over this issue.
Right.
Really, the only influence that Washington has, the nation that DC has, is over mortgage policy. That's pretty much it. Washington really can't tell, a municipality, we hereby order you to revise your building code, or to permit more projects, or to accelerate the timeline. I don't know exactly what's going on in Los Angeles. I do know that Gavin Newsom is trying to do that in California. I know that there's and again, the issue is it real, or is it just a political talking point? I know that Californians are, under Newsom, California is attempting to make it easier to build than it has been in the recent past. What that means from a tangible policy standpoint, I'm not close enough to it to know the answer. But yeah, it makes all the sense in the world.
Sure. I want to throw a curveball at you. I want to go back to our conversation about student lending and student finance, and talk about one of the aspects of a student loan that is so coercive from my perspective, which is the fact that it is unique in that a student loan cannot be discharged in a bankruptcy. And I think that that's one of the most coercive features of the entire system. And that's something that private lenders couldn't impose without Washington's blessing. So a borrower, student borrower who becomes insolvent, they can shed almost every other form of debt except student loans. And that's a protection that wasn't put in place for lenders. It was hardwired by Congress, and it emboldens those same educational institutions to raise prices further. I mean, students are going to have to pay whether they like it or not. So if the borrower can't escape the debt, the school faces no meaningful risk, which is that price insulation that we talked about earlier. What do you think about sorry, go ahead.
Yeah, that's not a curveball. I agree with you on that completely. And actually, it's even worse than that. The school never faced any risk, even when the loan was made, because the loan was a federally subsidized loan. So
there's that word again. It's subsidized. The government needs to stop meddling in these marketplaces.
Yeah, so I totally agree with you about the being unable to file for bankruptcy. It's the wackiest thing in the world. It's a little bit like saying, shoplifting under, $100 is a misdemeanor, unless you shoplift shampoo, and then it's a 200-year prison sentence. It's like insane.
Why is it that one shampoo that gets
why
the
is that
exception?
one form of debt? It's just lunatic. And the reality is, Western capitalism relies on bankruptcy. We would not have the economy that we have without the ability to file for bankruptcy. A healthy, robust bankruptcy system is an underpinning of Western democracy, or I should say Western capitalism. Excuse me. Without it, nobody would make any loans.
Sure.
Because it would be crazy. And also, again, kind of coming back to this point I made earlier, there's no underwriting standards. So we were talking about the mortgage. There was a tremendous amount of abuse in the 2000s leading up to the mortgage crisis and the wave of defaults and all the banks having to get bailed out. There was a tremendous amount of fraud, but at least they were committing fraud against real standards. Now the standards, the disclosures have tightened up. You can't do drive-by appraisals anymore. You have to actually validate your income. You have to provide, a tax return or a pay stub. You get a zero, money down. Coming back to that example I gave you earlier about the person who goes to UCLA and majors in engineering and has a $2 or $3 million, net present value return, versus the person who goes to UCLA and majors in art history or French literature and has a negative return. Why would you give them the exact same loan terms? It's just mind blowing. So yeah, it's just absolutely crazy. Nobody would design it from start. But I'll tell you one other thing, and you probably see this a lot because of the fact that you're a policy group, you're trying to influence policy, is once you get a constituency, they're going to hang on to that. Whatever it is government's given to them, they're going to hang on to it until you pry it out of their cold, dead hands. So it may be a terrible idea, but it's pretty hard to reverse something that has a big constituency that says, no, hey, we like it just fine.
Sure. Well, I'm so glad you brought up the constituency. Let's go through the numbers really quick. Which I'm cheating. I have them in front of me. I'm not recalling them. I wish I was that. I had that photographic memory. There are 42.5 million federal student loan borrowers across the United States, and across all of these borrowers, the average balance is $39,075, which totals 1.661 trillion in outstanding federal student loan balances, which is a sum that is larger than the economies of all but 15 countries globally. That is an outrageous sum of debt. That's
agreed.
Wild. Wow.
Totally agreed. I will say again, coming back to why are you borrowing the money? So I borrowed the money to finance an MBA. I took out student loans in middle adulthood. I got an MBA in my 20s. I definitely got support from my parents for sure, which I'm grateful for, but that support didn't cover the entire cost of my education. And my wife got a graduate degree as well. And when we both finished school, we maybe had $25,000 in debt, which was in the mid 80s, which today would be, I don't know, $125,000 if you adjusted for inflation. So it was a big number, but I was going to work on Wall Street. And so it's like, well, I borrowed money. Now, it could have gone sideways too, right? I might not have gotten the job I was hoping for.
Sure.
We might, the economy might have gone into a recession. My MBA might not have been the MBA is a diluted degree today. It was a hot degree in the 80s. It's way less hot today. It doesn't quite, turn into the earnings premium it did back then. So in some ways I got lucky, but I was pretty gimlet-eyed when I took out that loan. It's like, well, I think I'm going to be able to pay it back without a problem. So as opposed to what it has metastasized to today, which is, as you pointed out with those numbers, these are just crazy amounts anyway, I don't want to belabor the point. It's just, yeah.
It's wild. It's wild.
It's wild. It's a bad situation.
I'm going to try to pitch this piece to the Washington Journal, or I'm sorry, let me confuse all of these things. No, the Wall Street Journal. I want to pitch this piece to the Wall Street Journal. I know that they've been writing a lot on their editorial pages about the student loan crisis that is being, that the United States is experiencing right now. I'll see if they pick it up. But it furthers our work in the consumer finance space, and I'll send it to you. I'd like you to take a look, since I think that we agree on this subject a little more than on the housing policy.
Yeah, for sure.
Ed, it has been such a pleasure. We're coming up on 45 minutes. I'm going to call it. We're going to have to do another one of these sometime soon. I love the insight. Thank you so much for joining us today for another episode of SPPI-TV. Ladies and gentlemen, you can find out more about Ed Harris and Harris Northwest Advisors at harrisnwa.com. I think, Ed, we're connected on LinkedIn at this point. It was such a pleasure having you on. I appreciated the conversation. It was riveting. I'm really excited. I love talking about this stuff. Finance is our issue. But that was episode 29, the future of housing finance. I guess we should have just called it the future of finance. Oh, well. And we'll catch you next time on another episode. Ladies and gentlemen, thank you. And Merry Christmas, Happy New Year, et cetera, et cetera.
You left that one. You left that one.
Oh, which one? Happy Hanukkah.
There you go.
Oh, my dad would be so disappointed. He was a New York Jew, and we got all the high holiday experiences growing up. My mom was a Roman Catholic. My dad was a New York Jew, and I am embarrassed that I forgot that one. Merry Christmas, Happy New Year, Happy Hanukkah, etc. And we'll see you next time. Thank you very much.
Thank you.
Let me get that closing reel scheduled. Hang on just a sec.